Kia ora koutou. Kia ora koutou and welcome everyone. It's a real pleasure to have you join us today for what we hope will be the first of many very insightful sessions. We're thrilled to be hosting Satish Ranchhod, our Senior Economist at Westpac, who will be sharing his insights on inflation, interest rates, global market dynamics and local sector performance. It's an especially timely and important topic for us all, navigating today's financial landscape for ourselves, our customers and of course our businesses. Just some housekeeping to begin with. The webinar time has been extended to 60 minutes, so there'll be 45 minutes of presentation and then followed by a 15-minute Q&A. For anyone that needs to leave at the end of the 45-minute presentation, please feel free to do so. Otherwise, please stay on and participate in the Q&A session. We're using Slido as a platform, so you can ask questions and vote for your most liked question. You'll see Slido on your live screen, so please just type any questions in and hit submit. So this is an event for you, so we're going to run a survey poll at the end and we'd love to get your feedback, in particular on this event and any other topics you'd like to see in the future. Before I introduce Satish, I'd like to pass on a special thanks to Kate Fallow from Cairns for her input and ideas into helping bring this session to life. So Satish Ranchhod is a Senior Economist at Westpac New Zealand, where he has been a key member of our economics team since 2014. Originally from Wanganui, he brings over 2 decades of experience in economic analysis with a particular focus on inflation, domestic demand conditions. Prior to joining Westpac, he served as an advisor at the Reserve Bank of New Zealand, where he led critical research on the economic impacts of the Canterbury earthquakes and the global financial crisis. He is widely regarded as one of New Zealand's leading inflation experts and continues to provide expert insights into the challenges facing the New Zealand economy, including something dear to all our hearts at the moment, household budget pressures and housing supply issues. We're looking forward to a great discussion, so Satish, let's dive in.
Cheers, Mel. Good morning, everyone. As Mel mentioned, I'm Satish from the economics team at Westpac. Thanks for joining us today. Today, I'm going to take a look at some of the big factors that are shaping the economic landscape. And as Mel mentioned, we've got Slido chat running. If you've got any questions as you go through, please drop them through. And if we get a chance, we will take a look at how those are shaping up, and maybe we'll go through them as we go through the presentation. But we'll certainly come back to them at the end. We've titled our latest an economic update, Are We There Yet? And I think it's something that we can all sort of associate with after some of the long car trips we go on, whether it's as a passenger or whether it's as somebody who's driving and dealing with those pressures now. As individuals, as businesses, as a nation, we've been on a pretty long and challenging journey for the last few years. And we know that there are still some bright spots out there, low interest rates, good commodity prices. But I think we're all feeling that fatigue of waiting to see just when those boosts are really going to start flowing through the economy and when we're going to start to see some better economic conditions. And while we're optimistic about where the economy is heading, it is still going to be a little while before we really hit those good times. So still a way to go, still holding on, but hopefully we are going to see those improving conditions. What I'm going to talk to today are just some of the factors that are going to be shaping the landscape. And I thought I'd start off with a high-level look at how the economy has been tracking. So up on the screen now, we've got GDP growth, that big metric we use for tracking where the economy's been. And I've highlighted a couple of areas there. The first one there in red, that's the pandemic. And you can see really big swings as we went in and out of lockdown. Big swings on the upside as well as we came out. Now, for me, when I'm thinking about that, it doesn't really tell me a huge amount. The fact that economic activity dropped when we were all at home and the fact that it then came back rapidly when we could leave the house, that's not really a signal about economic conditions. That just tells me there was a physical block on activity. What's more interesting, these darker areas. That's where we've been for the last couple of years. And just take a look at where we got to. The downturn in growth that we had just over the past year, other than the pandemic, it's the deepest slowdown that we've seen since the global financial crisis back in 2009. And I think that really highlights some of the extent of the challenges that we've all been dealing with as a nation, particularly some of those big financial pressures from the cost of living crisis and the related increases in interest costs. Now, as we look out to the next couple of years, we do think that growth is going to recover, but there are a few caveats around there. First of all, it is going to be soft in the near term. The pickup that we're expecting to see really probably taking more shape as we go into 2026. And at the same time, it's likely to be gradual and uneven across the country, with some parts of the economy still seeing softer conditions for some time yet. So hopefully an improving outlook, but still a challenging one, especially in the very near term. Now, part of the reason why we expect the recovery to take shape over the coming year is that we've actually seen the big factors that should be supporting economic activity. And there's two really important ones that we're focused on. One is the reduction in interest rates, and the other is the strength that we're seeing in commodity markets. And those are both really important drivers for the New Zealand economy. So let's take a look at how some of these factors are coming through. Now, the first one I want to take a look at is interest rates, and that's been a really big one. Up on the screen, we've got the Reserve Bank's policy instruments, the official cash rate. And take a look at the swings that we've had over the last few years. Back in 2020, interest rates hit their lowest level on record, but on the way up, we had a rapid increase in interest costs, and it was one of the sharpest increases that we've had on record. Now, that was had a massive impact on the economy, both on the down and on the upside, but the ongoing impacts of those interest rate increases have been with us for some time. We're now moving into a new phase of the economic cycle, though. For the past year, interest rates have been coming down pretty rapidly. The official cash rate was cut again last week, down to 3%. Now, there have been a few questions about just how far the Reserve Bank was going to cut rates. Previously, they had signalled that maybe there was some chance it might drop below 3, but at their most recent update, they have highlighted that they expect that there are going to be deeper official cash rates than had previously been expected. They've signalled that the cash rate's likely to drop to 2.5% by the end of this year, and that is what our forecast is as well. And that will be a pretty important factor that will be boosting economic activity going into the new year. Now, it's been about a year since the official cash rate has been dropping, and when we talk to a lot of households and businesses around the country, a lot of them are still telling us that things are tough out there, even with those drops in interest rates. And it's raised a question about, well, should the Reserve Bank be going harder? Should they be cutting rates faster? And I can certainly understand that argument. It's pretty tough out there for a lot of families and businesses right now, and we've certainly seen softness in the jobs market. But there's a real question about whether we should be cutting rates rapidly in New Zealand. And I think a big part of it is down to the nature of our housing market and mortgage markets here in New Zealand. If I think about our friends across the ditch in Australia, only about 10 to 15% of them fix their mortgages. So when they cut interest rates over there, they see a really rapid change in economic activity. But here in New Zealand, most of us who have got mortgages, around 90%, will fix it for a period, usually around 1 to 2 years. And that's really important. If I think about those interest rate reductions, if you've fixed your mortgage rate, well, mortgage rates might have fallen a long way, but chances are a lot of us won't have actually felt the impact of it just yet. In fact, up on the screen there, I've got the OCR there in purple, but I've compared it to some of those popular fixed-term mortgage rates. But take a look at that black line there. That's the one-year mortgage rate. It's dropped a long way, about 200 points over the past year, but if you were fixed to your mortgage rate a year ago, well, you're still on a rate that's close to 7%. If you have a 2-year mortgage rate, even though it's come down to below 5% now, chances are you're on a rate that's in the 6s to the 7% rate. So interest rates have come down, but a lot of us haven't felt it yet. And that's part of the reason why I think there's still these clamouring for further interest rate cuts from the Reserve Bank. But I think we do need to take that with a grain of salt, because when interest rates do drop, we are going to see quite a lot of interest relief. In fact, if you've got a 1-year mortgage rate that, as we mentioned, was fixed at pretty high levels previously, when you go to refix now, you're going to be rolling onto a rate that is significantly lower, about 200 points. And if I think about what that means for the average household, if you've got an average mortgage in New Zealand, that reduction in the 1-year mortgage rate is going to put about $300 to $400 a month back into your pocket. And that's a pretty considerable saving for most parts of the country. If I compare it to the tax cuts that we had last year, they were about $80 a month. So this is an order of magnitude that is going to be significantly larger than that support. And importantly, like I mentioned, we haven't felt the full impact of that. But over the next 6 months, we're going to see about half of all mortgages rolling over onto lower interest rates, and that could be a really big boost. So it's really great that the Reserve Bank's cut rates. That'll help cement a recovery, but I'm a little bit cautious about just how fast they should go from here. There is already a lot of stimulus in the pipeline. And if I think about some of the lessons over the past few years, one of the biggest that stands out is that interest rate changes work. And if I think about what happened in the wake of the pandemic, when we had those big interest rate reductions, that caused a surge in activity, particularly in the housing market. We saw some really big increases in house prices. Right now, those interest rate reductions are in the works. We're waiting to see how far they come. And if you think about the other side as well, when interest rates rise, that has a big impact. And if we get really large interest rate reductions now, there is the chance that the Reserve Bank will have to raise again on the other side. So lovely to see that the stimulus is there. We want to see it flowing through and boosting the economy, boosting the jobs market. But we're always a little bit cautious, especially at this point in the cycle where there's already a lot of stimulus in the system, about not pushing things too hard, potentially really resulting in some unwanted consequences down the line. Now, even though as I mentioned, we've seen those interest rate reductions, part of the reason why we've had a slow response has been that slow pass-through, but we've also had a soft jobs market. Now, this is employment growth across the country, and you can see that it's been a pretty tough picture everywhere. In the nation as a whole, employment's down by a bit over 1%, but it's been very uneven. If I look at this chart, parts of the North Island, especially Wellington, really soft employment outcomes. We've had some pretty tough times. What's notable, though, is that it's spread across the country. We hear a lot of stories about some tough times in the public sector, and there definitely have been job losses there. But look at areas outside of Wellington. It's not just the public sector where we've seen job losses. It's been in big parts of the private sector, sectors like construction, retail and hospitality. They have had particularly tough times. And for a lot of families, if you've had somebody who's lost a job, or if you're concerned about your job prospects, that's certainly a factor that's probably weighing on your spending right now. If we look at the lower South Island, though, areas like Canterbury, Otago, Southland, certainly still a soft picture there. We've seen job losses, but much more moderate than in the North Island. And I think that really reflects there are some different factors that are supporting activity right now. One of the big ones that I'll talk about later, strengthen our commodity export returns, that really is giving a boost to some of those parts of the South Island. And even though because conditions are tough, they are feeling a lot more upbeat than other parts of the country. So a really interesting mix of conditions when we talk to businesses and households around the country right now. Now, one of the other reasons why the recovery has been gradual to date, and one of the things that I'm particularly concerned about myself, is inflation. For the last few years, we have been dealing with what is a significant cost of living crisis. That red line there, that's the Reserve Bank's target for inflation, the headline inflation rate that you'll hear about in the media. And just take a look at what's happened over the last few years. If I think back over the last decade, we really struggled to get inflation back to that 2% midpoint that the Reserve Bank aims for. But the last few years, we didn't just get to 2%, we went to 7%, the highest level we'd seen in decades. And those cost pressures have been widespread. Right now, inflation's at better levels. It's dropped back to 2.7%, within the RBNZ's target range, but even though that's a better outcome, I've still got a few concerns here. We're not just dealing with the current pickup in inflation. For a lot of us, we are still dealing with the fact that we had big increases in inflation over the last 2 to 3 years. And if your wages didn't keep up with that, well, the fact that inflation isn't rising as fast now, okay, it's a bit better, but you're still dealing with those consequences. And a lot of those increases, they came through in the cost of essentials, like your council rates, your grocery bill. Previous years, rents were rising rapidly. That's all really tough for a lot of us out there. So lower inflation's great, but it's not the same as saying that the cost of living crisis has gone away. It's just in a slightly different phase. And if I look out to the next year, well, I think inflation's actually going to rise back up above 3% before the end of 2025. And it's down to a few big factors that, again, are important for a lot of families right now. We've seen big increases in food prices, big increases in energy prices for household electricity as well. And that is going to be an important consideration for the Reserve Bank. Now, what can the Reserve Bank do about things like food prices and energy prices? Probably nothing much, to be honest. Those are factors that are beyond their control. But if I think about the broader underlying trend in inflation, well, that's that black line there. That's CPI. If we exclude some of those more volatile items like food or energy, it did show a similar trend over the last 2 years, got up to high levels. It's been coming down, and it's coming down consistently, and that is giving the Reserve Bank scope to keep cutting the official cash rate, even if food prices are rising in the near term. But I think that is something to keep in mind. Inflation's not low, and with a lot of stimulus pumping through the economy right now, there is a question just about how far it is going to fall going forward. But at least with inflation coming down, hopefully that is going to give the Reserve Bank scope to cut rates a bit more. But again, we should be a bit careful about how far we push things. We don't want to juice the economy now, end up with a cost of living crisis coming back or roaring back in a year's time. So still some important trade-offs there. Now, one of the other big features of the economy lately has been what's been happening in the housing market. I mentioned before, during the pandemic, when we had those big interest rate reductions, house prices rose rapidly. If I take a look at the chart there, we've highlighted where those post-pandemic interest rate cuts began, and you can see what happened to house prices. They rose rapidly across the country. In a lot of regions, we saw gains of about 30 to 40%, and that saw house prices rising well above the rate of wage growth. And it's, it depends on where you are in the property story as to how you felt about that, but it did create a lot of issues around housing affordability. And on the other side of it, well, interest rate hikes that we had over the last couple of years, we did see the housing market slow quite materially, especially in areas like Auckland and Wellington. It's been more resilient in other regions, especially Canterbury, but nonetheless, the housing market has cooled quite a bit. And even as we've had interest rate reductions more recently, the housing market hasn't picked up. It's still looking very flat right across the country, and that is pretty unusual. If I take a look at what normally happens with interest rates in the housing market, this is slightly complex sort of picture that we've got here. That picture at the top, that's the average of the 2-year and the 5-year mortgage rate. And if I compare that to house prices underneath it, you can see what's typically happened. When we get reductions in interest rates, typically it's associated with a pickup in house prices after a couple of months. And that's been a really consistent pattern over the last 2 to 3 decades. How mortgage rates play a really big role here. I mentioned at the beginning, we've had these big reductions in interest rates over the last year. What's happening to house prices? They're not rising. Right across the country, we're still seeing a very flat market. And that's really interesting. I mean, it's encouraging for first home buyers who want to get into the market that lower interest rates mean that affordability has improved, but it is a bit unusual. And house prices do play a really important role in driving economic activity more generally. As here in New Zealand, we hold a lot of our wealth in terms of housing assets, be it the family home or some form of investment property. And for the construction sector, typically they don't want to build into a market where prices aren't rising. So this is kind of an interesting dynamic for us to keep an eye on. And it's raised a few questions about, well, if interest rates have dropped like this, why aren't prices picking up? And a lot of it comes down to what is quite a different supply story than we've seen for a long time. If I think about what's been going on, even though prices aren't rising, sales have picked up. especially for first home buyers. Investors are also coming back into the housing market. But think about what's happened in terms of home building and construction in the last few years. For any of you who deal with businesses in the construction sector, I'm sure you've heard that there are a lot of tough times for a lot of builders and associated tradies. But this is the amount of homes that we're actually building. That's the residential work there in the purple bars, the number of homes we've consented in red. They have come down a decent way, but look at it compared to history. We're still consenting something like 30 to 35,000 homes a year. And that's actually a pretty decent rate of home building compared to history. And at the same time, a lot of people who had resisted listing their homes over the last couple of years, they're now bringing their properties to market. And it means that if you're a buyer, there's a lot more properties on the market. And even with those lower interest rates, those house price gains, they are looking pretty modest right now. And importantly, even with the downturn in construction that we're seeing, we're probably still building a little bit ahead of what's required for population growth. In fact, if I take a look at what's been happening to population growth, look at these big swings. On the screen there, we've got population growth there in red, net migration underneath it in the bars. Those are big migrations, the big factor that drives population growth in New Zealand. We had a big upswing the last few years, but right now, migration's dropped down to quite low levels. And that is another factor that is dampening demand in the housing market right now. There's just not the same growth in the number of people looking for houses. Now, this is a really interesting story for us when we think about what's happening to migration. Many of you will have seen a lot of stories in the media right now about outflows of New Zealanders to Australia and other regions. That is certainly happening. I think there might be a little bit of, it might have been a little bit overstated in the media in terms of just how big those stories are. There certainly is happening. We've got a soft jobs market here in New Zealand. Australia is looking firmer, and that is very attractive for a lot of people. But a lot of that is just a normal part of the economic cycle. If I think about what happens here, New Zealanders, especially younger New Zealanders who are earlier in their career, they'll often make a trip overseas for a few years to Australia or Europe. And when the job market is softer here, certainly makes it a little more encouraging. Importantly, I think we're towards the bottom of that story. And it's also important to remember there's been a couple of exaggerating factors. First is that we've just come out of the pandemic, and that did have a long tail, if you want to think of it in that way. A lot of people who delayed their travel, and the fact that we've had a catch up now wasn't too unexpected. But the other thing to keep in mind is that over the past few years, we had a lot of people coming into the country on temporary work visas. And those people, some of them do stay on in the country, but large number of them will leave when their visas expire. And it has been 2 to 3 years since those people entered the country. Those are a lot of the same people who are now making the jump over the ditch. So obviously, we don't want to have a big outflow. We want to keep people in the country, want to keep skills in the country. But I think potentially maybe the story's been exaggerated a little bit. And importantly, with signs that we're getting to the bottom of the economic cycle, we'll hopefully see a return to more normal levels of migration as we go into the next couple of years. Oops, pardon me. Now, if we step back on the household sector and we think about what's happening to businesses, it's also been a pretty tough time for a lot of businesses across the country. I mentioned before that some of the softer sectors have been areas like construction, retail and hospitality. We've seen it in many industries, but those are ones that have taken quite a knock. Now, this is one of the surveys that we get of businesses around the country. Each quarter they get asked, what's happened to your profitability? And if I look back over the last few decades, it tends to cycle around. You get ups and downs throughout any economic cycle. That red bar there, that was the pandemic. And it's unsurprising we had very low levels of profitability. But just look at the last couple of years on the right-hand side of the chart. Profitability squeezed for businesses for a protracted period, and it's a very large number of businesses who are telling us this, similar to what we saw back in the financial crisis, in 2008, 2009. And it's been a story that we've been hearing a lot across the country for a while. Businesses telling us that they're still dealing with rising costs, sluggish demand. it's been pretty tough, and it's meant that they have been cautious about their decisions about hiring. Many of them have been going through restructures or reducing staff numbers, and also cautious about their own spending. What's really interesting, though, is the nature of the feedback we're getting from businesses has been changing. If I think about where we were this time last year, businesses were telling us things are tough, it's getting worse. But when we talk to businesses around the country now, generally they still tell us, yeah, things are tough, but they're not getting worse anymore. It's more been a picture of stabilisation that's been coming about in a lot of parts of the country. And importantly, when we're thinking about where we're going over the year ahead, even though businesses are telling us it's tough now, they are starting to feel a bit more optimistic about where we're heading. And it is those lower interest rates that are really playing a role here. Businesses that we've spoken to are telling us, hey, it is tough for me, but I am optimistic about what's going to happen to demand, but they are holding on. They know that it's going to take a little while to come through. So still some tough times there, but hopefully that sentiment shift is telling us that things are going to be a bit different as we go into the new year. Now, the other thing that I mentioned earlier is that it is quite a mixed picture across the country. You know, when I go down south, it is a very different discussion to what I have when I talk to businesses in the North Island. When I was in Canterbury and Nelson recently, there was a really different vibe. Businesses, again, and households telling us, hey, things are still pretty tough, but they were definitely feeling more upbeat. And businesses who are connected to the agricultural sector, they have been telling us that things are looking firmer. Some businesses in the agricultural sector themselves are starting to dial up their spending again, albeit a little bit cautiously. And it is down to what are improving conditions for some of our key export markets. Now, up on the screen there, I've got the payout from Fonterra, and it is looking pretty good for the coming season. It's the second one in a row. Now, that is really important. You know, commodities still play a really important part in supporting our economy, particularly in rural sectors, but over time we see that income flowing out through the country. Fonterra is looking at a solid payout this season, and important with 2 big years in a row, that really has quite an impact on sentiment in our rural communities. 1 year, people are happy, but they'll hold on to it. When you get it for a couple of years in a row, businesses are more likely to spend, and we are hearing that some farmers have been increasing their capital expenditure recently. So great development there. If I think about some of our other export markets like meat, also doing pretty well right now, but there are a few sort of challenges, especially for areas like forestry, where we're selling into markets like China that are a bit softer right now. But this is a real star performer for the economy. So we're hoping that our rural regions will continue leading the economy as we go into 2026. And it's not just our commodities that are helping support activity. We're also seeing improving conditions in international tourism. And again, it's very important for markets like Otago, also in Auckland and other regions, but definitely those parts of the South Island that are doing well are also benefiting from the recovery in international tourism. Now, on the screen there, those are tourist arrivals from different nations. And if I look at where we're at now, you know, we still haven't quite gotten back to those peaks that we saw prior to the pandemic. The missing piece of the puzzle for us has been visitor arrivals from China. You know, China is a big market for New Zealand, or it was a big market for New Zealand. It was a high spending one. However, inflows from China have been subdued since the pandemic. The Chinese aren't traveling to other nations for vacations like they previously did, but we are seeing good arrivals from other countries. Australia, we've seen some great numbers there. The US, which is a high spending market, has certainly been visiting us. So it's an encouraging picture, and we think things are going to continue to gradually improve going forward. So again, our export market's really doing a lot of the heavy lifting in the economy right now, and fingers crossed that continues. It is a rocky global backdrop right now. Now, one of the big issues that we're wrestling with on that global front is changes in trade policy around the globe, particularly from the US. And trade protectionism, the imposition of tariffs, it's a really big concern, not just for us, but a lot of nations around the world. Now, if I look at that chart on the left, that's where the US gets its imports from. And you can just see what's happening here. They are really focused on nations like China, Mexico, Canada as well. That's where they get a lot of their exports from. That little black line at the top of that chart, that's New Zealand's share of US imports. We are 0.2, and I actually had to make that line about twice the size that it really is so you can even see it. We're not the key focus of US trade policy, but we are certainly wrestling with some big challenges here. If I look at the chart on the right-hand side, those are our main export markets. Yeah, the US is our second largest, taking about 13% of our exports. So very important for us. And a slowdown there or reduced access will certainly be challenging. But that's not the key issue for us. If I think about what's happening, the 15% tariff that's been imposed on us, it's going to cost us something like, 1 billion to 1.5 billion if we had to pay the full cost of that ourselves, or if it fell on our exporters in terms of lower returns. It won't all fall onto us in that sense. But if I think back to what I talked about before, those high commodity prices, that's adding about $3 to $4 billion into the economy. So more than what those tariffs are costing us. And this is coming at a time when commodity markets are relatively tight right now in terms of supply. So tariffs, they're unwelcome, but they're likely to be manageable given that we're still getting some good returns. The issue for us, though, isn't the direct impact of tariffs on our economy, but it's how it ripples through the rest of the world. And notably, I mentioned China as that big market that the US is concerned about. China's a quarter of our export basis, and if they slow, we could feel that downstream. And it's pretty important if that ripples through other markets as well, especially if, say, markets like Canada or Mexico are locked out of the US because of trade disputes. They produce similar items to us in terms of agricultural exports. If their exports are going to other regions, we might find ourselves facing increased competition. So a pretty tough story there in terms of what it means, but it's not clear how big it's going to be. At this stage, it's looking like it'll be manageable, but certainly one which raises quite a high degree of uncertainty for us. Now, one thing I'm very conscious of is initially it was suggested that we would get a 10% tariff on our exports. It's gone up to 15%, while the Australians, who again, exporting a lot of similar items to us, they only got a 10% tariff. Now, again, that's likely to, well, it is an unwelcome development, but likely to be manageable. If I think about those supply side issues right now, tight global supply for a lot of products like meat mean that we probably still will have a decent amount of demand for our exports. And if the Australians have greater access to the US, well, it means they're potentially diverting away from other markets. So there's still opportunities for us. Not a great position, but still hopefully going to be a manageable picture for us. Still a lot of uncertainty to go. We're only into the first year of the second Trump presidency, and there's a long way to go. Now, I just thought I'd wrap up with a look at one or two particular issues. The one that I'm really interested in right now, government spending. Now, over the last couple of years, in the wake of the pandemic, we did see some big increases in government spending, and we've had large increases for an extended period. Going forward, there's a question about how much more spending we can accommodate. Because there is a growing demand and a growing need for spending in some big areas. If I think about what's happening in the economy, we're a growing economy, we're an aging economy. We're going to need a lot of spending in areas like health, education, police, areas where there is a strong social demand for that sort of expenditure. But there is a trade-off there. If we want increases in spending in those areas, and we are talking about sort of necessity spending, not some sort of vanity project, we do have to pay for it in some way. And on the screen there, I've got the government's debt position. You can see that over the last few years, it's risen up. The government's stated target for where they want debt to be, we're still hovering above that, and we're likely to sit above it for some time, even if the rise looks like it's been arrested. But this is going to be pretty challenging. I mentioned we've got those areas where we want to see increased spending. But if I look at what's happening to the government's plans for spending, they're still pretty flat. And I'm not sure how plausible that is, especially heading into an election year next year. And that is going to be a really interesting issue for us to address as an economy. If I think about some of the trade-offs that we're facing, we want those services, but if we want to get them, we do need to have that discussion around the nature of how we fund it, or a look at the tax base. And you can already see that argument starting to float its way into the media and into political discussions around exactly what level of taxation we have, what do we tax, and that discussion is going to become much more to the foreground over the coming year, And it'll be a really interesting one, because there is this discussion around, do we tax income from earnings, or do we look at taxing other forms of assets, things like capital gains on property, things like wealth. And it will be a really interesting discussion. I suspect much of the discussion will be centered around capital gains. That'll be really, again, one where there are some quite strong views on either side of the argument, and I can't tell you which is the right or wrong answer here. If I think about the capital gains discussion, when we talk about this, it's largely related to residential property. And as I mentioned earlier, this is where a lot of New Zealanders do save for their retirement or other forms of savings. And for years, this has been a pretty reliable source of savings for us. And a lot of people, they have followed the rules, they have built up their asset, and now they're told, we're going to change the rules on you, you want to get more tax. They're naturally sort of a bit concerned about it, but at the same time, this is, again, another form of income that a lot of people have had, and it raises a question about, well, shouldn't it be taxed? And there's related issues about access to the housing market. Are you getting, can people get in? So it's one where there's some valid arguments on both sides of the story. I suspect the political zeitgeist around this, it is changing over time. And also so is the discussion around what do we want and to provide in terms of different assets, things like superannuation. It will be a really interesting election as we go into next year with discussions on both sides. Superannuation, again, is another one where I think there'll be some pretty involved discussions when we look at the sustainability of that long-term funding and what access is going to be in terms of things like KiwiSavers. So some really meaty issues that are going to be coming up. But one thing I'm really focused on is that this isn't just an issue for next year's election. These issues that we've got around funding the services that we want, it is going to be with us for the next 2, 3, 4 election cycles. And it doesn't matter who's going to be in office. They're going to be dealing with these same sorts of trade-offs. So it is going to be a really interesting one for us. Now, just to wrap things up, I thought I'd take another look at how things are tracking across the country. And this is retail spending from Westpac's own data. And you can take a look at the split that I mentioned before. If I look at the left-hand side of the chart, Wellington, parts of Nelson, and the top of the South Island, Auckland, they are certainly seeing some softer conditions. Those financial pressures that we've been dealing with, they really are squeezing a lot of households across the country, and it does mean that the economic climate right now, it is still pretty tough. It probably is going to be for some time, but we know that there are those positives in there. If I look at the other side of the chart, areas like Southland, Otago, they are seeing some of the benefit from those high commodity prices over time that'll ripple through the economy. We've also got those big interest rate reductions and probably more to come that'll be a big driver of growth. So it is definitely tough out there for a lot of us out right now, but there is reason to think that the year ahead, it's going to start to look firmer. But still pretty tough in the near term, and still some challenges, both around, as we mentioned, around the fiscal side of things, also the inflation picture. Going to be a really interesting year ahead. Now, that was all I was going to say for this morning. Thank you for your time. I think we've probably got a few questions that Mel and I can work through if we want to switch over to that.
Yes, thank you, Satish. We're now going to move into our Q&A session, and just a reminder that will continue on now for another 15 minutes. If you need to leave, please feel free to drop off anytime. Otherwise, please pop your questions into the Slido on the bottom of your screen, and then you can also vote on which questions you'd like to be answered.
Cool. I might sort of actually start off with one that's already in there. We've got a question there about ageing population issues in the economy over the next few decades. That's a really great question. I mean, New Zealand does have an ageing population right now, and it raises quite a few issues in terms of what are our spending needs going to be, how are we going to fund different services. And if I think about it, one thing that we often talk about in economics is called a dependency ratio. It's the number of working people to the number of retired people. And that ratio is changing over time. There are fewer and fewer people of working age compared to those who are past retirement. And that does affect how we fund things. If I think about it, your tax base in terms of the demand for services is looking smaller. And it affects, well, what do we want to fund? With an aging population, you certainly do need more aged care, more healthcare. Interestingly, you need slightly less on education, but we're also spending more on related things like retirement support. And I think that's a really challenging issue for us because we have to think about, well, what's the sustainability of our superannuation scheme? And that's a really tough one. Because we obviously want to provide for people who have been working their lives, but I think we are going to have a discussion about just how that is going to work. And it might be the case that political parties on either side of the agenda of the spectrum do think about, well, what is access to superannuation going to be like? I've heard people suggesting increasing the age of entitlement for superannuation. I'm not a fan of that myself. I think there are real issues, especially if you're in more physical industries. So it's okay for somebody like myself. I've got an office job. If I needed to work longer, I don't want to, but I'm probably physically capable of doing it. If you're in an industry like construction, where your body is sort of taking a lot of strain a lot of the time, asking you to work longer is quite tough. And there's an additional issue there about different ethnicities, with certain groups in the society, particularly Māori, having a lower life expectancy. Increasing the age of entitlement, I think, raises a few issues there. But we're still going to have those issues. So I suspect that we might look at things like means testing. And again, not an issue that is often popular. Obviously, if you've been working for a long time, you naturally have saved, but it may be the way that things go, where we have to think about, well, if you're in a position to provide for yourself, maybe you're not getting as much as somebody who isn't in that position. Or maybe we're going to look at things like KiwiSaver and the level of contributions that we make to try and ensure that things are sustainable. But it is a really interesting one. And it also has another sort of overlay in terms of why do we have an aging population and people leaving the country, as I mentioned before? Because a lot of the people who leave the country, they are in the earlier careers, they are highly talented, and there's a question about how we maintain those skills. And people do leave, a lot of them will come back. We want to keep people on shore, but it does also bring into focus the fact that we need to bring in other people with skills that are hard to develop in New Zealand into the country to maintain our skills base, maintain our tax base. It's a really interesting discussion that we're going to have for quite some time.
I've got a question here, Satish, for you. Do you think our government can actually influence our economy, or are settings at the Reserve Bank, international geopolitical climate and the private market influences actually much bigger factors?
I mean, I think that all of those factors play a really big role, but at different sorts of frequencies. If I think about what you want to do to get an economy running quite quickly, monetary policy and the Reserve Bank probably has a bigger impact because it affects things quite quickly, things like the exchange rate in particular, interest rates. But as we talked about earlier, it even takes a while for the Reserve Bank's interest rate changes to flow through because of that mortgage fixing story. Those other factors that I mentioned do play an important role, and government policy has a really important role, but over a longer time frame. If I think about some of the changes that we often talk about, if you're changing planning rules or things to improve productivity, boost education and employment, they take a long time to flow through, potentially several years. So very important, but with a very long lag. And those other geopolitical factors, we are still a small nation and we are riding those waves. But I think domestic policy really still quite an important factor, but one where it does take a while to have an impact.
Okay, next one. Thank you. Will US tariffs drive up inflation in New Zealand?
Yeah, that's a really interesting question. And we talk about this a lot. There's been a lot of media stories about increases in inflation and as a result of tariffs. I don't think they will in New Zealand. If I think about what's happening with tariffs, for the US, Maybe, if it certainly implies that it costs somebody over there more to get a good into their market, may not all go through to consumers. Wholesalers, retailers may take some of the brunt. But here in New Zealand, we're still not. We are still looking at an environment where our cost of getting goods into the country hasn't changed. And potentially, if we see a slowdown in growth in other regions because of tariffs, it might be a bit of a drag on inflation. So not necessarily a factor that I think will push up inflation even in the US, but definitely not one that I think will be pushing things higher here.
Right, thank you. Next question. Why does Australia not fix mortgage rates in the same way as we do in New Zealand?
This is a really interesting one. We've been asking our colleagues across the ditch this as well. Ultimately, it's the appropriate financial decision. If I think about mortgage rates here, if you're fixing for 1 to 2 years, you're looking at a rate that's a little bit below 5. If you're floating, you're getting a higher rate. It's a financially sensible decision to go for longer terms and lock it in. But if I look at Australia, it's often the other way around. You actually pay a bit of a premium to lock in those more certain longer term rates. If you're over there, it makes sense to maybe carry the risk that mortgage rates are going to change and float. That's the thing. It is down to, does it make sense to fix your mortgage rate?
Right. Next question, we've got quite a few voted for this one.
Sure.
Should the government remove tax exemptions for churches and iwi before looking at taxing individuals on wealth or capital gains?
I think the question here is, are you a commercial entity? If you're involved in a commercial activity, like you're producing a good or service, it makes sense to discuss, should you be paying income tax, just like any other commercial activity, put it on an even keel. It's a bit different if you're purely a publicly focused organisation where you're not making money, your benefits are focused on you providing benefits to your community. But if you are making a commercial return, if you're operating in a commercial manner, then there's certainly an argument for taking a look at those sorts of issues. Whether that would be a massive sort of game changer for government revenue, I haven't seen the numbers, but it would be interesting to see.
Thank you. Next questions. New Zealand is a SME-heavy economy. Company liquidations are rising 30 to 40% year on year, and bankruptcies up in Q1 FY25. Will the IRD's shift from tax leniency to aggressive enforcement affect our recovery prospects as a country?
Ultimately, the IRD is focused on ensuring people pay the right amount of tax, but I think the bigger issue in terms of the pace of recovery, the extent of those challenges for business will be the strength of economic growth. And we are certainly in a low point right now. That's why we've had that pickup in bankruptcies. And it was mentioned in the question that it's been heavily centred in SMEs. That includes a lot of operators in sectors like construction, hospo, where you often do have a relatively small, potentially family-run business with a few employees. Those are ones that have faced some tough times recently. I think we really need to see economic growth picking up, and that'll be the factor that drives it more than anything else.
Yeah. Thanks. How are we doing compared to Australia?
Yeah, this is a great topic. I've been talking to quite a few people about this recently because, if I think back over the last few years, we've had some quite different cycles. New Zealand over the last few years has certainly had some tougher times. But looking ahead, we think New Zealand's actually going to grow a bit faster than Australia. A lot of that's down to interest rates, though. If I think about what happened over the last few years, New Zealand had a bigger pickup in inflation. We had larger increases in interest rates to offset that, but it also meant that our economy slowed by more. And over the next few years, our interest rates are continuing to push lower. That'll boost growth, but we are still struggling with a softer labour market. Now, it's a bit different in Australia. They took a more gradual approach to interest rate increases. They didn't have inflation rising quite as high. And it's meant that their economy has remained firmer, but going forward, they aren't going to see the same sort of interest rate relief, even though their interest rates are coming down. So they've still got relatively tight interest rates. It's a bit of a trade-off there. They are probably, in a better position, certainly with a firmer labour market, and that's important for a lot of households. But if we had taken things a bit more gradually here in New Zealand, well, I think the risk is that we would still be dealing with some of those really big or really high rates of inflation that we had. It certainly wouldn't have come down as far as that did.
And if you're interested in reading more on that, I read an article that you were quoted in yesterday as well, so just Google search that. How would a change in government in 2026 change forecast growth? This is a really good question.
Yeah, it is getting a little bit hypothetical because we don't know exactly what the composition of that government would be and exactly what the nature of their policies would be. But I think there are some big areas that we mentioned that any government who's coming into power is going to be looking at, or even if the current one stays where they are. And again, tax settings will be a really important one, both for households and for businesses. Also the nature of regulation. And I think going beyond strict economic policy, there's also a clear focus around where we're spending socially, and because there's a real discussion around social spending and what that does to a nation's, if you like, human capital, what spending in areas like health, social welfare do in terms of longer term needs for that sort of spending and outcomes. So some really interesting areas to tackle off. Both sides of the political spectrum have got some policies that I do and that I don't like. I can't really say which way would be the best one, but certainly quite an interesting time out there with some very mixed conditions across the country, both regionally and across the income spectrum.
Great, thank you. Keep voting for those top questions. We've got 10 minutes left. This is an AI question. When is the AI hype bubble going to burst?
AI is really interesting. I mean, there's hype and then there is reality. And, maybe there is sort of a little bit of overblown issue about should AI be in everything. But in terms of what it actually means from a practical work sense, I think it really will be very, very important for a lot of us, especially in professional industries. And I think the issue here is, for me, it's analogous to the growth of the internet and e-commerce if going back 10, 15 years, or even more so. When that first happened, none of us quite appreciated what its impacts would be. If I think back to a lot of services sectors like, movies, cinemas, taxis, they all sort of acknowledged this sort of thing, but they didn't really think their business would be affected. What happened is that it's not something that their business changed, but a different sort of competitor sprung up. Your Uber versus your taxi driver, or Airbnb in hotels, greater proliferation of things like Netflix. AI potentially has these unexpected channels as well, where it's going to flow through how a lot of us do a lot of things. I mean, we're already using it in what we do, changing the nature of our analysis, and that's still at a very sort of simple level. For more advanced people who are conducting research, I've had some really interesting work in areas like gene examinations and things like that in scientific fields. This could be quite a significant change. So, yeah, maybe there is a little bit of hype right now because we are in the early stages of adoption. But in terms of its impact of our workflows and what we do, I think we'll still see some pretty significant impacts come over the coming years.
Yeah, great. I can tell how much it's affected the way I'm doing things as well. I was speaking with a philosophy student last night, and how you actually teach younger people how to think if AI is just going to do it all for us. So it's going to be very interesting going forward. So we've got a question. Next question is, what are the recurring popular themes, perhaps exaggerations, in the New Zealand media around our economic outlook that you don't agree with?
I guess there's two that have struck me recently. One is around the extensive departures to Australia. And like I mentioned before, there have been a decent amount, but a lot of that, in my mind, is simply a reflection of the economic cycle. And we've had a low point in economic growth. It's natural that people move. We've had previous inflows that are moving abroad. And like I mentioned before, a lot of those were actually recent migrants to New Zealand. So certainly we don't want to see people leaving, but I'm always a little bit concerned about sort of commentary around some of these stories about the extensive migration outflows in the media. And it happens on the upside as well. People sort of talk about how it's getting overblown, but some of these are natural cyclical variations. The other one, and it's not just in the media here, is around the pass-through of interest rates and how deep interest rate cuts could go. 'Cause there's certainly some tough times out there. Lower interest rates could help, but I'm also really conscious about those lags that we talked about and how long it takes to come through. And again, I'm struck by one of the big lessons from the from the pandemic, is that interest rates really do work. If I think about what happened there, those big interest rate cuts that we had took a while to flow through, but we saw a big swing in activity, particularly in the housing market. The interest rate hikes that followed really had a massive dampening impact. Now we've had some quite big cuts. People are calling for more. I certainly understand the need for that stimulus, but I still think we should approach it with a bit of caution. We don't want to eventually end up having to make bigger swings on the other side because we had some unintended consequences.
Thank you. Will fixed home loan rates drop any further?
Really interesting question. And, I can only sort of speculate here. This isn't, Westpac policy. But in general, when we see the Reserve Bank continuing to cut rates, you sometimes do get a little bit more pressure on shorter term interest rates, particularly in around, maybe, the 3 to 6 month. Certainly floating rates get a little bit of downwards pressure. But longer term interest rates, when you're going out 1 to 5 years ahead, they don't just price off the OCR. So when the OCR drops, you don't get a huge amount of movement there. And they also make some allowance for the risk that the OCR could drop, which is what markets are expecting right now. So even if the OCR comes down, you might get a little bit of movement in longer-term fixed mortgage rates, but we don't expect it to be as large as you'd see in some of those floating rates.
So keeping now on the assumption of the interest rate kind of theme, question is, does the assumption that interest rate reductions work to boost the economy hold when we've got other expenses like rates and insurance absorbing that lower interest payments? Good question.
Yeah, a great one. We went back and took a look at just how some of those increases have been. Rates have been rising at a rapid pace over the last few years. We've got another sort of large set probably coming through this year in most parts of the country, especially the further south you go in the country. And those insurance costs, they're easing off now for some people, but definitely not all. When you do the numbers in terms of what these mean for household budgets, changes in interest rates on average are a much bigger driver, but some of that is going to get eroded by those increases in essentials. And I think that's part of the key thing, is that these are increases in the cost of essentials. You cannot avoid them. So we still expect that interest rates will be a key driver of activity, but it is being dampened by some of those inflation pressures in other regions. But I think that also reinforces the importance of keeping that inflation picture under control. And the cost of living crisis hasn't gone away for a lot of families. People often sort of mention to me, well, couldn't we just accommodate a little bit higher inflation for a while? And it's like, yeah, you can, but you don't just get higher inflation for a while. You bake in higher cost of living for an extended period. So really it's an interesting set of challenges there around cost of living and interest rate costs.
So CPI for the most recent quarter is 2.7%, yet the true felt inflation for most people is much higher. And a good example of that is the price of butter. Yeah. Insurance, rates, power, shrinkflation. Does CPI remain an effective measure? And CPI, can I ask, can I add on my own question at the end of that? So does it remain an effective measure, and do we release it or calculate it often enough? A lot of countries over the world do it monthly. We're on quarterly. Yeah,
let's start off with the first part of it. That felt measure, I think, is actually pretty real for a lot of us, because CPI does genuinely track the basket of goods that households on average buy. It is a genuine reflection of our spending habits. But what matters to us isn't just our average spending. Because if I think about the average household spend, it's about 20% goes on about food, something like about, and probably about another 20% goes on different sorts of accommodation costs. There's big chunks on other things like apparel, furnishings for the home. But those things that are going down in price, or we've seen lower inflation, they are things like furnishings, some apparel, electronics, Those are things that you don't have to buy. They're nice to haves. But if you think about the things you have to buy, your food, your rates, your insurance, your electricity, maybe your rent, those are where we've seen big increases. And that's why it often feels like inflation is a lot hotter, because it is where you have to spend, where the price gains have been. And I think that is pretty material, because it also matters depending on where you are in the income spectrum, because lower income families do tend to spend more on those essential items. They're also less likely to have a mortgage, which is where some of that relief comes from. So it is a pretty important one. If I think about what that means from a policy perspective, it's pretty interesting. Should we be leaning harder on inflation as a result, which would mean higher interest rates or some other sort of measure, or should we accommodate it more? But if you accommodate it, well, as I mentioned, you're still stuck with those issues. I think it really is an interesting discussion. But as CPI as a measure goes, if you're thinking about overall activity, well, during good times or when things are okay, you still do buy those things, and keeping in mind those other costs, it is still important. It is a good measure. But from a policy perspective, if you're thinking about other sorts of things that the government might look at, certainly looking at those essentials, I think, is a pretty valid thing. In terms of your issue that you mentioned about its frequency, we would love to see more inflation data. Stats NZ's quarterly CPI is the benchmark measure, and it is quarterly, but we do get about half of the index every month, and that is giving us greater insights. That's why we think inflation is going to be pushing higher in the near term. And we know that Stats NZ has already announced that over the next year or two, they are going to transition to giving us a monthly CPI release. I think that's a great initiative from them. And Stats NZ, when you talk to them about these things, they are really helpful in terms of what sort of insights they can provide. But it is a complex job, and it's a big job to collect that many prices. So taking us a little while to get there, but we're going down that path.
Okay, well, we are bang on 10 a.m. So thank you so much to everyone for watching, and thank you, Satish. A recording will be provided in the post-event email that will be sent to everyone, and there'll be a survey poll to the right of your screen. So please give us some feedback on today's webinar, and we want to make it bigger and brighter and better for next time. So that will help us doing that. And from all of us at Westpac, enjoy the rest of your day.